If you are higher rated, you can easily raise up to 10 years at a very reasonable cost. If you are low rated, then your cost will rise. The terms also will be reduced maybe to 5 years. But usually below single B, the market access will be lost. Invest only by single B or above. Another important issue is the investor relations. Investor relation basically is the communication between PDMO and other potential investors. Most investors in single B emerging market bonds, Euro bonds, are mutual funds. The major mutual funds like BlueBay, some of the PIMCOs, GMOs, these well-known names, they usually are very good at predict the risk of your countries. But still, you needed to prepare a lot of a presentation, goes to their office, make the case about your country, why they should buy your bonds, what are the risk mitigation in your country. Needed to set up a website to present all the information, MTDS, DSAs, key projections, and roadshow materials. Also, you need to establish a database about who are potential investors. You keep good communication with them. You send up them quarterly update about your countries, whether the situation is improving. So the investor relations are also very important. It will help you to, reduce the risk perception with some of the key investors. So that's pretty much I want to talk about, that's about Eurobond issuance. If you have any questions, I'll be happy to take it now. Otherwise, I'll pass to John to talk about how to develop local government bond markets.
Okay, seems like no questions there. Let me try and get this. There we are. Hopefully that is available to everybody. So, thank you, Hui. That was how external markets are to be approached, particularly for first-time borrowers. What I want to do now is to talk about how you can develop the domestic government securities market. And you'll have heard me discuss all of these training and discussion sessions the importance of market development.
John, could you please put it in the
yes.
slideshow mode?
Sorry, yes, that's it.
Yeah, thanks.
Okay. So I'll try and explain what we mean by a developed government securities market, and hopefully from that you can understand the gaps and the deficiencies of your existing government security market. I'll talk about the benefits of a developed government securities market, and these are quite substantial, and hopefully a new PDMO will understand that it's worth putting quite a lot of effort into developing the government securities market because of these benefits. Talk about what factors and institutional arrangements are necessary for developing the market. You need to take from an underdeveloped market to get to counter to other investors because there are pricing structures involved, and these are open and they can access buying and selling securities at any time. A developed market is a deep market, and we mean by deep market that these auctions in the primary market and the transactions in the secondary market can be performed in reasonable volume without disturbing the pricing structure of the market. In many less developed markets, you can, as a government, you can say, well, I'm going to have real difficulty issuing this amount of bonds. next week without having to pay up a lot more than I have paid last week. If I reduce the volume, then I can get the proper price, but only at that reduced volume. That is not a developed market. A developed market means that a reasonably large increase in volume should not disturb the prices. Obviously, it has to be a reasonable volume. You can't suddenly go out and say, I want $1 trillion and expect the market to take it. But what a reasonable volume is depends on the market that you're in. Not moving again. Okay, in a developed market, the market is deep and liquid for most individual issues, not just a selected few issues. So that in the government securities market, you will borrow in individual instruments along the yield curve. And those individual instruments should be liquid and deep. So you don't want individual issues that are very small, very different to each other, because investors won't like that. They won't be able to say, I can find a buyer for this particular bond, or I can buy myself these particular bonds that I need, because they're not traded. Most of the issues that you issue in the government securities market should be deep and liquid. Developed market also has a sufficiently wide yield curve, which simply means that there is a range of instruments from month treasury bills typically out to about at least 10 years. Many developed markets are then even further out to typically 30 years, and in the last few years, even out to 50 and 100 years, but those normally are not what we call deep and liquid. So certainly out to 10 years, the yield curve should be fairly deep and fairly liquid. And issues should range across the whole yield curve, so that when you're extending the yield curve out to 10 years, you should not just issue 5 years, and it's probably better to issue 7 and 8 years as well, until, as time passes, the liquid 10-year that you issued becomes 9-year and an 8. You fill up the yield curve, so that there are tradable issues across the whole yield curve through the length of time it's been operating. The reason for that is the government and investors can transact at all maturities of the curve, so that if you as a government need to issue 5 years, it's available. If a pension fund as an investor wants to maximize the term of the investment, it can go to 10 years and it knows that it can buy 10 years. A developed market, the primary market issuance is efficient, and this means that auctions are regular and well publicized.